Loading up Tesla here, and we're talking about Tesla today, folks. This company is one of the most overvalued gems you could possibly find. Every time I analyze this company, it just seems to go higher and higher and higher. But now it's coming down a lot. Currently sitting at 197.08 at the time of recording this video. But here's an interesting thing about Tesla. When you look at the company metrics, what this section of this software does, it compares the 5-year averages to the trailing 12 months. So we can kind of contrast and compare where this company's been and where they've been and where they're currently doing. So with Tesla, our current PE ratio is 55.41. Still a premium. It is still at a premium price for these earnings. However, their 5-year average PE is 627. That's astronomically high. Astronomically high for a company like this. But then you go down the list and contrast and compare. You have an EPS that's sitting at 3.20, or a 5-year average, it is 0.07. So we are up on the EPS with a lower PE ratio. That is a good sign. That's very good. PE ratio being as high as it is with a obviously low EPS, not so great. ROE in the positives, 31.86%. 5-year average return on equity is in the negatives, right? Compare that to the profit margin, sitting at 14.95% compared to our 5-year average being negative 2%. So immediately, I am liking this more and more. Like, I'm not saying Tesla is a bad company. I like the company, but my thing is, I want to own a company at a fair valuation, and I don't know if it's at that point just yet. I'm still thinking it's fairly overvalued. But here's why this section of the software is important. You can see that even though the PE is getting to not so much of a premium, your other key aspects are being raised, where in the last 5 years, on average, it was just a complete disaster. Now, our net income is currently sitting at $11.19 billion, which is great. Free cash flow is at $8.9 billion, which is phenomenal. And on average, it was at 500 million. 500 million, $500 million in free cash flow, currently sitting at $8.9 billion. That's phenomenal. Look at this return on invested capital trailing 12 months. 24% compared to our 5-year average of 2.12%. They're making moves. Allman Z-score is incredibly healthy, and Piotrowski score is healthy as well. If you don't know what the Piotrowski score, essentially it compares the return on assets, different assets, and improvements from a year-to-year basis. 9 is the highest score we could possibly achieve. Now, Tesla's score is 7. So on a year-to-year basis from last year to now, they've hit 7 of the 9 categories. That's pretty good. I got to give it to them. And with that being said, folks, we bring that over to the financial evaluations of Tesla here, which takes a look at the cash flow statements, the balance sheets, and the income statements. All those lovely statements that the company provides. We're grading this a 5 out of 10. Not a healthy score. And a few of those things we've talked about. One being their PE ratio being incredibly high. We like to find companies that on average have a PE ratio of 22.5 and below. Tesla isn't that company. As I said, trading at an extreme premium. However, it's coming down. Current ratio is 1.46. Ideally, we want to find companies that are 1.5 and higher. That just indicates to us that they have a decent amount of assets on hand to cover those liabilities in case of some hardships ahead. So let's say in a case of a recession, that's right around the corner, and I bring this up in a lot of my latest examples. Can they liquidate any assets to cover those liabilities in case they are in a pickle? Right? People have less disposable income to spend. Maybe they're not buying that many electric vehicles, hence Tesla. Something to think about. That's where my mind races. As well as the return on equity average is currently sitting at 11.55%. That's in the negatives. Sorry, negative 11.55%. So they're getting no points awarded there. The return on invested capital is also not getting them awarded any points because it's sitting at 2.12%, where we want to see on average a 10% return on invested capital. However, the trailing 12 months, as we discussed, is pretty healthy. And their share dilution has been increasing by 2.71%. That is not a good sign. That means that they've increased the amount of shares outstanding. We want to see this number decreasing, or at the very least staying the same. So as a shareholder, if you're owning this company, you are owning less equity of the business because now you're sharing with other people. That's not a good sign, folks. So They're losing points in those categories. However, where they are gaining points are in some key ones as well. They have a low debt to equity ratio. They have increased their EPS by 62% over the last 5 years. Amazing, great job. They have a 5-year net income growth of 381%. The free cash flow is up. The revenue growth is up as well. So these are also the trifecta of revenue, free cash flow, and net income. Super important to me, and they've hit those 3 markers. So that's great. This price needs to come down a little bit more. We'll find out what the intrinsic value of this company is in just a quick second with the price analysis section. And if you're wondering what I'm using, folks, this is a software that I've built along with some other key developers. You can access it at leodeleo.com. There's a 7-day free trial for this software, and if you like it, use the coupon code down below to get 20% off. Founder coupon down below. You can find it there. You can research any company on any exchange from New York to Toronto to Euronext market. So my Canadian friends, obviously we have the TSX, and my American friends, everything you can think of. So with that in mind, we're going to do a price analysis to try to find the intrinsic value of Tesla. I'm going to use these historic numbers as references to see where this company can go over the next 10 years, because that's what I like to analyze. So I'm going to fill out these lovely boxes, and we're going to talk about it and why I filled them out the way I did. And folks, if you're enjoying the video so far, hit that like button, hit the subscribe button. It means a lot to me, it means a lot to the channel. I'm gonna click the calculate button and we're gonna get this on the way. Now, this software that I just mentioned earlier, so far it's currently in the desktop version, but we are working diligently to get it on your mobile device. You'll love it once it's on there, so you can do stock analysis research on the go. But right now, it currently is on your desktop, so if you want to use it there, that's the place to do it. Now, jumping in, show you what I did, folks. See some red numbers here, but I'll talk to you what I've done. If you're new to the channel, I like to try to stay as conservative as possible to try to give myself the most margin of safety. So even though I'm seeing 70% revenue growth, 52% revenue growth, and 89% revenue growth, this is obviously a 1, 5 year, and 10 year numbers. I like to try to stay within some realistic expectations. So I've done 23, 25, and 27%. Why such low numbers, Leo? Why are you using such low numbers on Tesla, the Elon Musk company? It's a 600, wow, this was at $1 trillion market cap once upon a time, guys. Do you remember that? Now it's at 600 billion dollar company. Here's the thing, folks. I don't think they're going to be able to grow these astronomical numbers going forward, especially with the likes of GM and Ford and all these other EV companies nipping at their heels. I just don't think that they can keep up with production. So I am staying conservative with those numbers. Now, if they end up beating these numbers, then something to reconsider. But I don't personally see them beating these numbers over the next 10 years, given the economic conditions of the market and a recession. Now, profit margin. I've stayed true to the 1 year number that I'm currently given, so 10%, and our trailing 12 months is currently at 14.95%. So I'm going to do 5 on the low end, 15 on the high end to try to get somewhat of a balance in there. Free cash flow margin, I got 4.49% and 6.47% for the 1 year. So that's what I did. I hovered between 4 and 6. So this is just a ballpark of what they currently have done over 5 years, 1 year, and 10 year. So this is, I guess, a healthy way to, let's say, utilize these numbers. Either give it a haircut and go from there, or you can just put whatever the last year has been if you think they're going to currently do that and match it over the next 10 years. I don't like to do that. I like to use the lowest numbers on the board. So with that being said, I did 14, 16, and 18, desired return of 13%, and here it comes out to be, folks. The average price for Tesla is $138.57, 61 on the low side and 225 on the high side with this earnings multiple. That's with a PE ratio of 18. So that's a real outlier, I gotta say. But that is including 27% revenue growth over the next 10 years, 15% profit margin, 6% free cash flow margin. So if you believe, I mean, this is obviously skyrocketing the price a lot, but average comes out to 225. So if you believe these numbers here, guys, the most that you should be paying for this company is $225, and you can expect a 30% return over the next 10 years. This is a complete utter outlier. That's an 18% PE ratio. To me, it makes sense to buy it somewhere between the conservative average and the moderate average. Now, you may argue, you may say, Leo, these revenue growth numbers are low. I can't tell the future, folks, And you know what? You may be right, but for me to for this company to make sense, I need to know that they're able to grow at a low revenue growth number. Obviously, the higher the revenue growth number is, the better it is. But you got to factor in, okay, the amount of time is 10 years. That number may shrink. So if I already start off with a shrink number, I'm giving myself more of a safety net. So between $61 and $129, maybe somewhere in there, maybe low hundreds, something like that. A far cry from where it's currently at $197.08. So what is being said here about Tesla? Well, it's the same story over and over again that when I've currently analyzed this company. It's the fact that this company has just been so overpriced. Look at the 52-week range here, $196 to $402. My God! But so far, Tesla is an overvalued company here. If you want to see a company analyzed, write it down in the description box. Write it down in the comment section below. I'll take a look at it. I'll add it to my ever-growing list. What I meant to say was, if you want to get this software, the links are in the description box below. And if you want to get your hands on the software, it has obviously the intrinsic value calculator, the company's metrics, the financial valuations. It's a one-stop shop for all that you need to take a look and analyze a company on the fly. This software pays for itself, folks. So, folks, that's the video. And I'm going to say thank you so much for watching once again. I will see you in the next one.